Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. The year is flying by. Tuesday, July 16th, 1 o'clock on the East Coast. Me, Dan, soon to be joined by who, Dan?
Carter Braxton Worth, CBW.
That's right, of Braxton Worth, of Carter Worth Charting or Worth Charting. No, nothing fancy, just charts, if I may. Another fascinating day here at 1 o'clock on the East Coast. A lot to talk about. So let's throw the rundown up because that's what we do here. The Russell resurgence, little known fact. Our second dog, Russell, is a King Charles Cavalier Spaniel. He's 13 and a half. So I don't know if they're talking about that or the IWM. We'll figure that out. I have a difficult time doing the third person, but Guy's gold hits new high. I didn't realize it was my gold, but there you go. Chart check. Stocks reporting earnings. I mean, there's some big movers on the back of that. And audience Q&A because we have learned that people enjoy that, Dan.
Yeah, we're also going to update a trade idea we did last week in crude oil.
Which is working out nicely for you. You did a nice job on that.
Yeah, by the way, with Guy's gold, you're doing okay in that too. So you know what they say about a blind squirrel. Every once in a while, Guy, what does it get?
It gets hit in the head maybe by walking into a tree or something. It gets a nut.
It gets a nut.
Right.
Let's get into it. You called today fascinating.
It is.
You know, why is the stock market up, Guy, today?
Because it's open. Because it's open.
All right. And we don't have to rail against that, but we can talk about some of these rotations, which is interesting. Carter's going to look at the charts in the Russell 2000. I just want to make one point before we get there. You can talk about rotations all you want. The market cap of the Russell 2000 is $3 trillion. The market cap of Apple is $3.5 trillion. The market cap of Nvidia is, $3 trillion. The market cap of Mike, so you can do the math there. It doesn't really matter. Have fun with the Russell 2000, bid it up 10% in a straight line in 4 or 5 trading sessions or whatever, but you better see it broadening out. Now, are we seeing it broaden out to financials? Sure. Okay. And I think a lot of those stocks, if we could pull up a Wells Fargo really quickly, I think this is interesting. On Friday afternoon, Guy, it closed down 6% after reporting Q2 results, giving guidance. People were not happy with net interest income. We talked about that. Look at this thing. It's filled in the entire gap, right? And we mentioned that last quarter, you know what I mean? JP Morgan was down 6% the day of its earnings, filled in the gap within a couple of weeks, and then continue to go higher. So that's where a lot of the rotation is going into, right? And I don't know if there's any other sectors that are kind of catching your eye, but to come out of mega cap tech, we see Nvidia down 2% today. We see Microsoft down 1%. We see Google down 1%. Tesla was down this morning. Now it's up again. So again, money is finding a home, and the S&P is kind of going back and forth among
hanging in there. I mean, so yesterday was interesting again because at one point the S&P went negative yesterday, I think, or at least unchanged, and then it bounced late. And today at one point, I think the S&P was unchanged, and now it's bounced a little bit as well. So a lot of moving parts, but your point is well taken. The Russell, as important as we make it out to be, and I don't want to diminish it, but as you just said, the entirety of it is effectively one of those 3 stocks in terms of market cap. So you got to put things into context. I'm surprised. I mean, obviously I shouldn't say a lot. I think maybe 20% of today's Dow move-ish, maybe 18% is the move in UNH. I'm sure Carter will talk about that. He's talked about his love affair with that chart. But, it's one of those days where you just don't see that often where, the outperformance of the Dow up 1.5%. And at one point today, the Nasdaq was down 0.5%. You don't see that all that often, Dan.
Yeah, no doubt. Well, let's bring in the aforementioned Carter Braxton Worth of Worth Charting because we're about to get a lot smarter on this program right here, Guy Adami. Hey, no doubt. Carter, how are you?
Dubs.
Who doesn't like aforementioned?
Yeah, that seems like something that CBW might
say. It seems antiquated, but hey, whatever. It's a very clear word, as mentioned before, a little cleaner than that. So there we go.
Yeah, I mean,
1 word instead of 3.
Half a dozen to the other. That's an expression that, again, not particularly useful. We can just say this or that. All right, Carter, we want to do a little work on this Russell 2000. You made this point on many occasions. You take all 2,000 stocks, you add up their market caps, and it's still not greater than any one of the top three in the S&P 500. But here was a quote. This is from Bespoke. We like these guys over there. If current levels hold, this will be the biggest 5-day outperformance that the Russell 2000 has ever seen versus the S&P 500. This would eclipse the prior 5-day stretches ending on October 19th, 1987. Guy, that was the day you started in the business.
Well, a year or so prior, but point taken.
Okay.
Thank you for that.
And then again, in that post-COVID crash, Carter, talk to us when you see this sort of data again. And like, I know you're going to have some charts to kind of run through this a little bit, Russell versus the S&P, but thoughts here.
Yeah, there's a lot out there. I've seen other work like this that shows when you have this kind of outperformance in small caps on a sort of 2, 3, 4-day basis, multiple 100 basis points, that it's typically market bottom, which is remarkable. The market performance is quite good in all sectors in the market as a whole on a rolling 3, 6, 9, 12-month basis. You'll note the 2 periods there cited on the screen. That's right after the 87 crash, generally a good time to buy equities. Then, of course, at or near the COVID low. So the question is, what is it, right? Is it just rotation, or is it risk embracing? Meaning, almost definitionally, at a market bottom, you want to be long beta. If this is a market bottom, it's hard to think this is a market bottom when we're streaking to new highs every day. But the point being that small cap, by virtue of its risk reward, let's take small cap banks, for instance, very risky. But when they go, small cap biotech, but when they go, right, small cap retailers, but when they go, they really go. And so it's twofold. It is rotation in principle, money. You'll see the Nasdaq 100 down today, money coming out and seeking other sources. But it's also speculative. And so it's speculative, and one could say, but that's animal spirits, and that's good. Or one could say that's typically at or near the end of a period when people are out of ideas, nothing left to buy, and they're willing to buy almost any thing. Yeah. And so hard to know. There's all sorts of cycle work done on election years. We also know market performance when the Fed starts cutting, having been in a tightening cycle. And you can massage any number of data points to get any outcome you want.
You brought some charts, so I mean, these are going to speak volumes in terms of this pennant formation that we've been in, the subsequent breakout. You brought some other charts as well, so walk us through.
Yeah, I mean, this is beta at its best. Think about the COVID low, the surge, almost a triple, right? And then we obviously, over the past 6 months, this year, starting in January, have moved out of this formation. Let's draw it another way, and so let's flash those. While we've resolved that pattern, what we're back to, and you can see this clearly in the second, is that there's a lot of overhead supply now, right? Some of the, not to say easy work has been done, but at this point, up considerably to a level where supply interested sellers are lying in wait. So we shall see. My own hunch is, and we sent out a strangle on the KRE. The KRE is largely what's leading some of this, along with biotech. But after moving up this many days in a row, this steeply, a lot of bulls and a lot of premium in the calls. And then is it really going to drop 10% and give it all back in the next 15, 18 sessions? Highly unlikely. I would strangle it, bet against volatility after a very volatile 5-6 day move.
Yeah. And just to be really clear, when Carter talks about strangling it, he's selling an out-of-the-money call. He's selling an out-of-the-money put. If the stock or the underlying ETF just goes sideways or stays within those bands, he's going to capture that premium. So again, after a big move, that's how he's playing it. I think it's an okay way to play as far as an ETF. I'm a bit more cautious as it relates to a single stock. And I know because, again, there's certain stocks that could get taken out above that short call, or you could have a big gap, below that short put. But I think you tend to do these. I think you've used the expression.
Well, we use Walmart, Amazon, Costco, Tesla, stocks that cannot be bought out. We remove that possibility, and that highly unlikely to drop again. But yes, here's the thing also about it, just not to make it a strangle curve, but for 1 minute. Well, because what if it goes above? It keeps going. But the point is, but if it keeps going, then it'll be that much more vulnerable to some sort of check back. So you can overshoot the upper band and then fall back in it, or fall now, but then ricochet. But being inside the band has a high odds bet.
Hey,
The
guy.
relative. Oh, go ahead, Dan. I was going to
No,
ask.
I was going to say this. So walk us through why you think, and you've highlighted this on many occasions, but I just want to kind of make the point right now. We've talked about small cap stocks. So you have this, 90 some percent probability, if we're looking at the Fed Watch tool here, of a September 25 basis point cut. Walk the viewer, the listener, through why we've seen this 10% move in a straight line as the odds for cuts have increased.
Yeah, well, I mean, part of it obviously is rotation. I mean, that's as clear as day. I mean, the second part, I think, is the fact that the underperformance for so long in the Russell is finally being said, okay, we're going to get the all clear from the Fed. It appears as though September's a foregone conclusion. I think Brian Moynihan today on his call on one of the shows suggested that he was going to talk to his team, his analyst or his strategist, because he sees 3 rate cuts this year. I think he said September, November, and December. I don't think there's a meeting in October. So that's out there as well. So I think the market is taking some solace in the fact that, the Fed's going to have their back. And theoretically, the most economically sensitive and some of the most rate sensitive names are going to find their way into the small caps. That being said, the fact that so many of these small caps in large part are made up of small and regional banks, where theoretically they should see some relief in terms of the yield curve sort of re-steepening perhaps, and rates going lower. So you throw all that in the mix, and people are trying to play for relative value and things that sort of could potentially be the catch-up trade. And I think that's what you're seeing exactly now. But that leads me to Carter's next chart, because I think this speaks as many volumes as the prior charts did, this relative performance of the Russell informed through the IWM and the S&P 500, because to me, this would suggest that we're probably exhausting ourselves here, which is sort of what Carter, I think, was alluding to.
So this is, look, it's always about making money. Did you make money today? Did you lose? Did you make money for 3 days? But at the end of the day, this is a tough, if you were to take this one slide and go around and say, my strategy is to get and always be long small cap stocks versus the S&P. That's like saying I bet on underdogs all the time, on low price baseball players and low price football players, betting that they'll have a big year and they'll have low price actors. You want to go with the big stuff, right? And so over time, there is this notion that small cap outperforms. It's just not right. What outperforms is big moat-like companies, because also there's risk-adjusted returns, right? If you adjust for volatility, even in periods where small cap, you're embracing so much risk that as a Sharpe ratio, if you will, or however you want to designate it, you're not getting paid for the risk. And the point is here, look at this ricochet, all so big, but you can barely see it on the chart.
Yeah. Well, here's the other point. You just made a great suggestion about, how money goes back into eventually these companies, these large companies with big moats. But when I think about the period we're about to go into, so Q2 earnings, and guys made this point on many occasions, for some of these mega caps, this is going to be really important, because if they don't put up the numbers in Q2 or guide in Q3, that justifies the multiple expansion, right, that we've seen in some of these big names. Microsoft's trading 37 times, 34 times next. Apple's trading 35 times this year, 33 times next. You're going to see, I think, a slight re-rating, or maybe not so slight re-rating in these names over the next couple of weeks. And, again, you go back to last summer, we remember when a lot of these names, the narratives around generative AI were white hot, and these stocks still sold off 15-20% as the S&P went down 11%. So talk to us about the QQQ. I think those top 10 names or so, Carter, make up nearly 50% of the weight of this ETF.
Yeah, so I thought we'd look at a long-term view. At some point you're saying, wow, we're looking at the same charts overnight. I certainly think to myself, I'm sitting around at midnight, 3 p.m. in the afternoon. I've already looked at this 10 times, but if you change the time frame, you look at it a different way, sometimes things emerge. So the one thing to note here is that while this is barely a trend line, just connecting a few points, we have moved slightly above the internal trend line, in effect, since the dot-com boom. So we have sort of peak valuation then. We had equally peak valuation in late 2021, early 22. And while if you look at any price of sales or price to PE chart, it's not as high as those two other points, we are now above that line. Let's look at another way to annotate it. So this is the channel that's been in effect, and you can see it's to the penny since the 09 low. So the question is, like, now that we've come out through the top, do we head to the top of the channel? The bulls are arguing for that. That's only about 8.5 to 9% to get to the top of that blue sort of 45-degree channel. And so let's just look at that channel itself. I mean, if that's what's coming, that is 10% more, just to be fair. Now, if we were to look at just before we change the charts, from the point at which we bounced off the lower band, that would be late 2022. Right, that's October, a year and a half ago. Let's look at this sort of rhino horn, this last spurt up close and personal, and there it is. And so, this itself is steep. Breaking this, if we were to break down here, and we're acting a little heavy, to be fair, and break out of this, then we go back to the preceding chart. What we would have the risk of is going back to the lower band of the channel, which is certainly possible. My own hunch is this is a case of surely wanting to be less big. Because look, here's the truth. If you look at short interest over any 20, 30, for all short interest, it never gets more than 2, sometimes 2.5% of all listed. Most people are long, right? Churches and synagogues and museums and endowments and colleges. So look, if one wants to take a short view and every once in a while, that's fine. But at a minimum, if one is long, surely decrease exposure to Nasdaq 100 type names.
So I look at this real quick, Carter, and I'm going to ask you a question on the back of it. Where we are now in the scope of this channel suggests where, if you go back again 16 years, we're smack in the middle of the channel. And for the most part, every time we've gotten to the middle of the channel, there's been sort of a move back down to the upper, so to the lower end of the channel, like that lower band of the channel, except for obviously that one move up we saw in, I guess it's 2021, 22-ish. So the odds suggest we're going to stall here. Now, I say that in the context quickly, Dan, in NVIDIA, and I keep bringing it up, but I'm going to bring it up again if we could throw up sort of a chart to illustrate this. We talked about it on March 8th, which was a Friday. We talked about that engulfing pattern. You wrote about it, and by the middle of April, NVIDIA had traded down some 24%, having sort of chopped around for a couple of weeks prior. And the same thing happened, Carter, on June 20th, and it's the same type of price action. We're chopping around over the last couple of weeks, but, my instincts suggest that we're going to see the same type of reaction over the next couple of weeks as we saw into the middle part of April earlier this year, which would suggest that we stall out in terms of where we are in the channel of the triple Qs. That's a long-winded way of saying I do think you faded here.
Well, to your point, Guy, we know that we're not going to get NVIDIA's earnings, I think, until about August 23rd or something. So the third week there. And, I'll just make the point that 40% of their revenues is Microsoft, Amazon, Google, and Meta. So we're going to get a good read on the CapEx from those companies. And our good friend Doug Cass at Seabreeze Partners, he just sent us an email, Guy, and I just got off doing with Deirdre Bosa, OK Computer, that will drop tomorrow in your favorite podcast store. And we were talking about some similar data here. AI capital expenditures have increased by about $70 billion next 2 years from the Mag 7. The sales expectations from Mag 7 are unchanged for that period relative to expectations a year ago. So Goldman Sachs was out with a report last week. Sequoia was out with a report. Guy, you saw, Roger McNamee speaking to David Faber on CNBC last week. Sooner or later, you're going to have to show us the money for these investments. And I think that's the point that Doug's making. If you're making all these investments and you're not getting a bump in sales increases, then sooner or later that's going to weigh right on your profitability. And so that's the story. So if we start to see a deceleration in expectations as we get to the back half of the year, that's how you get from the July highs to maybe a sustained period of redistribution, or as Carter put in very technical terms, less big in some of those names.
I'm with you, and I think that's right. And, I read some of these reports. The Roger McNamee interview I actually watched a couple times. David pushed back, correctly so. But, when you start, it's not anecdotal anymore. When you start hearing, multiple people start talking about that, again, you can disagree with it, but you have to take it into consideration. So it's out there, and the technicals, I think, support that view as well. Carter, great job with rates. Let's pull up our chart real quick. Here we are, and you've talked about it. if you really think about it in the context that you brought forth, a lot of noise, but with basically where we've been, for quite a period of time. It's how you get there, I guess, is sort of interesting. But, here we are once again.
Yeah, I mean, again, I mean, it might just be, and I know I'm repeating myself, that rates just don't matter in the sense that they're not doing anything because they aren't directional, right? Sometimes things kind of are where they belong. You see that in stocks all the time. You're like, all right, this stock really isn't on the ascent or the descent. It kind of belongs here. The asset is sort of priced right. And that might just be the case here with 10-year yields, right? That they don't belong, if you can use that word ever, at 5, 7, 5, 6, which was literally a consensus when we were above 5 just 6 months ago. And they don't belong at 3.25, which in February was consensus because we were 3.75. Remember, it's recency. People always extrapolate what's going on and assume more. You see it all the time. And typically when you get extreme swings, it's right to do the exact opposite. It's a pair of twos.
Yeah, but it's interesting, Guy. And to that point, if you look at the CME Fed Funds Tracker, I know we flashed it up a second ago, everyone's on one side for a September rate cut. It looks like 100% probability, right? And then if you look at, November, it's also suggesting that you have nearly a 70% probability, right? So I guess to me, that also sets up the other way where, who knows, maybe there's a couple, hot inflation prints and then you start to see September go down, right? And so do you unwind a bunch of the stuff, the KRE, the Russell 2000, that's the stuff that I think is worth kind of keeping a close eye on, Guy.
100%. And again, my bear case for bonds, the reason why I thought yields would go higher, and there have been points in time where I looked right, and obviously today not so much, but both these candidates that are running for president, that election is going to come up very quickly. I think they're both inflationary. I think there's still supply demand imbalances out there that the market's not taking into consideration. And I do think at some point, the debt that's out there matters, and it's going to manifest itself in rates. Obviously, that's not happening now. I think what's sort of taking the lead is the fact that you've seen weaker economic data, which is supportive of the bond market. In other words, yields go lower. And on top of which, I think some of the calculations the market's making in terms of what the Fed is going to do. Although I'll say for the 100th time, the Fed definitely controls the front end. I don't think they control the back end or sort of the medium term, for example, 10-year yield. So we'll see how it plays out. But right before our very eyes as well, you're going to start to see, and you're starting to see it, this re-steepening of the yield curve. And the question is, what does it mean for the market? And that's something that I know Carter brings up. I know you and I talk about it. Liz talks about it. And it's yet to be determined. But as Liz says a number of times over the last couple of years, it's not the inversion that gets you. It's the re-steepening that you have to be concerned about.
All right, let's take a look at gold. This has been something that, again, it's been range bound for the last few months or so. You've been a buyer, Guy, on those pullbacks, okay, going back to May, and there was another one into June or so. Last, I guess it was July 9th, you detailed a bullish trade in the underlying commodity here. Talk to us a little bit. I think it was, buying it at 23.66. Your target was at 25.50. That was your initial target here. So talk to us how you're managing this trade.
Yeah, look, I think, the gold trade, I think, is still intact. The miners are starting to participate. Carter can speak to that in a second. I do believe, for all the reasons that we talk about over and over again, just the environment that we find ourselves in, gold works. And I think even, the armchair technician would look at this recent sort of 4-month sideways action as a bit of a consolidation until this next leg higher. And that's what I see right here. So sorry about that. I think you stay with the gold trade. And I understand people will say that they've gotten burned so many times over the years trying to play gold for a breakout. I think it's happening right before our eyes. And I think, you're on the precipice of something significant happening in gold, and throw silver in the mix as well, because very quietly that's been on its horse too, Dan.
Yeah. So Carter, tell us what you're seeing here in the gold. I know that you have been bullish of the gold.
Just exactly. I mean, sometimes there are buy and hold trades. One could say, yeah, you should just buy and hold Apple and Microsoft, Google and Nvidia and stay forever. But this is a structural thing that's been long in the making. We know that it only recently broke out from 5-year highs, and it's just a small asset. It's underowned. The miners are completely underowned. All them added up, market cap don't amount to more than probably 300 billion. One stock in the S&P is a gold miner, Newmont, and this is what's the expression? Proved by test of time. Yes,
Yeah.
This is real stuff.
Yeah, no doubt. Hey guys, so let's talk crude oil here for a second, because I think, you were a little surprised when it kind of fell off in early June. It got below 75 from that $80 level. And then you say you'd be a buyer there. I heard you on Market Call saying it a couple times. I heard you on Fast Money saying it. And so last week, you and I were taking a look at the crude futures here, and I just think for a whole host of reasons, I thought this was a good spot to kind of sell it and play for a move back towards maybe mid to high 70s or so. And I was surprised that you actually agreed with me right then. What was your thought process there? Because we put on a trade, and maybe Amanda, she can flash that up for a second right there. There it is, selling at 82, using 84.5 stop. And so what I would do now is, you see that moving average down there, it's been going sideways, to Carter's point. Maybe it's just where it should be, right? And maybe that's what it's suggesting. But the idea that you maybe get a 50% retracement of that move off of the lows, that's what I'd be playing for. And then I'd move that stop down from 84.5 to my entry point around 82.
Yeah, and you said that I agreed, and I didn't agree with a smile on my face. It was sort of begrudgingly, because the definition of insanity is doing the same thing over and over again, hoping for a different result. And so many times over the last sort of year and a half, it appeared to me that oil was about to break out to the upside, only to have sort of the back and fill once again to the moving average. So it stood to reason that we're going to see it again. And you just mentioned sort of a 50% retracement. Back of the envelope suggests 77.5, 78 will be that. And that probably sort of lines up with where the moving average is. So this was a well-constructed trade. If you think about it, it doesn't matter again, but a day early-ish in terms of the timing, but you're never going to nail these things to the letter. And it's working out, I think, exactly how you thought it would.
Yeah. Carter, thoughts here? I mean, we just discussed, obviously, that moving average. I mean, it's basically where it was a year ago.
Exactly. It is a pair of twos as well. When we were down there in the June lows playing for bounce, had some merit just as being extreme, and then now it is again. It's always tempting. At least I'll speak for myself. I see something here. I see a trade, but there is no trade. I know that we've done a trade, and you were talking about it. But if you didn't know what it was, this is Foot Locker. Is this IBM wandering around DuPont? You just I don't know. Do I have to do this? You'd say I'd rather go play golf. I just leave this thing alone, right? I just would leave it alone.
Well, here's the thing. Guy and I don't play golf, Carter.
I know. I don't either.
we're just gonna bang around in crude futures here. All right. So, as we said, we teased it. It's earnings season. We already talked about that Wells Fargo that's filled in that gap. This is an interesting one. United reports, I think, tomorrow, and then Domino's. You had a report out on Worth charting, people. So go over there. You can check that out. But some pretty decent size implied moves, 7% in either direction for United, 5% in either direction for Domino's. Guy, thought on, let's say, United. We had Delta last week. I think the stock was down a bunch after results. They had some decent things to say about demand, but they saw like a pinch on earnings a little bit.
Well, I mean, I look at a United chart, and you go back to middle of 2020, and it's another one of these names. It's been in this sort of $40 to $60 range, and it's been sideways. And I think the way you play it is it gets down to the lower end of the range. This is one, and that's Carter's chart. If you do a more if you do one of our charts, you'll see over the last 5. You see exactly what I'm looking at. So there's your sideways action, and it's pretty well defined in terms of your range. So we're sort of getting down to levels where I think you want to look at the playing this from the long side. But I think right here, unfortunately, and I'm not trying to shirk your question, but I think we're smack in the middle of a range. So you're sort of flipping a coin here. Same thing with Delta. I mean, Delta's been in a similar type of range. Recently got up to 54, pulled back a little bit. Airlines, as Tim Seymour says, are trading vehicles. So you have to sort of pick your spots. But for United, for me at least, Dan, I think you're coin flipping here, unless you think you're getting along against the moving average. Maybe that makes sense.
Yeah, Carter, walk us through a little bit because not
Yeah.
only do you want to look at United, but you also want to look at the ETF that tracks the group.
Yeah, the group is a tough rate. It's in like Ford Motor, is that it, or Macy's. Ford's the same price it was 40 years ago, right? Airlines. But look, I think there's a tradable trading for balance, at least a small gap fill. Let's annotate it. You see the chart, you see the trend line. So small up. Delta did not do well in response to its quarterly results. But my hunch is just buy, sell, hold. I'm a buyer. But speaking to airlines in general, and we can look at this is the jets, and this is the issue. Like, what is that?
Mm-hmm.
And you'd say, well, what happened to that thing? Did they miss the drug? Is that FDA approval there in early 2020? That's no COVID, right? Nobody flew a plane for. But just to make a point about airlines, I think this is a pair of twos. You see the situation. We have other charts here just to look at something. So watch these two lines. Let's flash those. That's less generous, more generous. You through the trend line, or you not? Sort of, not really. Pair of twos. But in terms of airlines overall, take a look at this next. This is the ETF. The ETF only goes back to 2016, and it's meant to track, right? This is the New York Stock Exchange airline index. Let's look at that airline index in all history, because this thing's the same price it was in 1994. And this is the point, right? I mean, these are more airline bankruptcies than banks practically. And so, again, you can catch it for a trade, but you got to know what you're doing. And what you're doing is it's a bottle cap. Sometimes you get it right, sometimes you get it, but it's not an investment.
Yeah. All right. Let's look at Domino's again. We mentioned that you had a report out. I'll tell you this. While Guy has a lot of vowels
Work there
in his last name, you probably, the first time you have Domino's will be, the last time there, because
but yes, and I know we're sort of up against the clock, and I don't want to keep, but Amanda, maybe she can put this in the show notes. I actually worked at Domino's for a day, if you recall. So
yeah, yes,
I've not had their pizza in a while, but I was a past employee, as I was a past employee of many places. Please,
yeah, that would be on CNBC's Fast Money. You were also a UPS guy. You were a Shake Shack burger
Lyft driver, a lot of things.
A whole host of things. We got to get back to that. All right, Carter, walk us through the Domino's here reports, I think, on Thursday.
Yeah, well, next chart, there are only two. We can flash them, take them on, take it off, put it back. I mean, my own hunch is we're going to bounce here, right? And so we have a 13%, 13% sell-off, $75. And to some extent, that's associated with the swoon in McDonald's and Starbucks. But the main thing is this stock peaks in late 21, early 22, as does the stock market. And it bottoms, of course, in the middle of 2023. But just to put it in perspective, the S&P, we know in the 22-23 bear market dropped 27%. The QQ dropped 37%, and this dropped 57%. This is yet to recoup all its losses. The S&P is well above its prior high. I would think Domino's comes at least back to the high. So playing for a balance, earnings coming up.
Got some questions. Go ahead.
Oh, I was just going to say, Guy, because, McDonald's, we've been tracking Chipotle. There's a lot of different action in this space a little bit. Thoughts on the Domino's?
I understand what Carter's looking at. I mean, you want to bounce off this moving average, which makes sense. But I will tell you, the recent price action in some of these names, even Chipotle, for example, which was on a huge tear, a lot of these names are sort of giving it back. It's going to be fascinating to hear from Domino's if they're seeing some of the same customer pressure in terms of price that McDonald's has seen and some of these other fast food or medium, I don't even know what you call it, mid-range food are seeing. So I understand why just trading, you want to play it against the moving events, but this is one where I'd rather hear what they have to say first, in my opinion.
All right, cool. Do we have time, Guy?
We do. Quick, and Carter, stick around for this. Because couple of them sort of you can talk about. Jack CF, risk reversal. Is UNH going to be making an all-time high soon? So huge move in UNH today. Throw up a chart. But what you'll see, I think, is basically a trade back up to that prior high. So the amount of volume that we're seeing, and if you could do longer term, you'll see exactly what I'm looking at. I mean, this suggests that, maybe we're sort of getting to levels where it's exhausted itself before, Carter.
Yeah. So back into the range in which it's been mired for almost 3 years. Ultimately, look, this is a very sort of high quality defensive domestic business, right? That's the nature of it. And it has in that sense. Politics aside, obviously, Congress can always rewrite rules that affect these companies in particular, but that's sort of unknown. That notwithstanding, I think this is just a great consolidation, and the stock is fully rested and should go on its way. If we did a 30-year chart of this thing is like 10x over Lilly, which is incredible. This is the one of the greatest, because think about it, it is truly idiosyncratic, right? It doesn't care about Putin, it doesn't care about China, it doesn't care about U.S. elections. It really is just an incredible growth stock, and that's only 10 years. The all data chart is incredible. So
now look, I mean, it's an amazing, and it's quite frankly, I mean, you could actually make still with this move a pretty compelling case on valuation. So we'll see how it plays up against these prior highs. Mordecai Cohen, why has silver been lagging gold lately? Well, actually, lately silver started catching up, but your point is well taken, Mordecai, that obviously silver at current levels is a little more than half of its prior all-time high, whereas gold is making an all-time high. But recently, silver's been getting on its horse. So, I think silver has some more room. I've said a number of times, Carter, I think somewhere between $38 and $40 is where we settle in. But the construct and the content of the essence of his question is not lost on me, nor is it lost on you. Thoughts on that?
It's a little bit small cap, large cap. Gold's the bigger one, the shiny one, the one that central banks buy. Silver's, they refer to as poor man's gold, which is sort of pejorative. But the point is that, yes, lagging, but when it goes more. Anyway, and Malachi, great picture there at the top of the Metropolitan Museum looking out over the skyline. So, yeah, onward, upward, large silver. Go.
That's what it is. That's a good looking picture. I didn't see that. Well, good catch by you. This is from our friend Wavy McFly. Dan, this is right in your wheelhouse. Seems like we're about to repeat the bull market of the late 1990s to 2012. Emerging markets, commodities, industrials. Once the air comes out of these, again, I don't use the term, but the stocks that everybody talks about. Thoughts on that, Dan?
Yeah, and I think this goes to what Carter just detailed with the charts in the QQQ. I mean, you could easily see this thing up another 10% before the technicals get too extended. I'm looking at the QQQ that traded as low as 418 or something like that in late April, and here we are at 494. At any spot you might have been able to say at 460 it looks extended. It came in just a little bit, then it broke out and made a new high. It even made a gap. You don't see too many gaps in something like the QQQ, but that was in mid-June, and then it consolidated towards the end of June. Then it made a new high, and it's consolidating again. Maybe it makes a new high and goes up. So to me, let's just think about it this way. You go into earnings season, and again, we know how concentrated this index is. We know also those names that are 50% of the NDX, the Nasdaq 100, are also 30% of the S&P 500. So if you get better than expected Q2, and they're able to guide above the whisper, when I say they don't all have to do it, but a few of them do that, then, people get back on their horse because they remember the late 90s. They remember the S&P going up on average 30% a year from 1995 until the jig was up in, late 99, early 2000. But I would make the argument, because generative AI, it's been on our radars now for 2 years. And when you look at the price appreciation, because of it, I'd say sooner or later, you're just going to need a cooling off period greater than what we saw last July to October.
Real quick, last one. This is from Chris. Do you guys have any thoughts on NXPI? By the way, I think they report on the 22nd with earnings coming up. Chip company, heaven in the auto industry. I think the last time I looked, this has been lower left, upper right. It trades less than a market multiple. It has the commensurate earnings growth that suggests it's probably still cheap. It's one of these stocks that you have pullbacks along the way. Every time it pulls back, the market gobbles it up. I sort of like it in the earnings. Maybe it's just me, but I think this is one, at least for me, Dan and or Carter. You can make a pretty compelling case on valuation in an environment where people don't seem to care at all about evaluation.
I like it a lot. I think it's a very fine chart.
Yeah, fair enough. I mean, like, Guy, you made the argument, I think, prior to Broadcom's results. It was about a month and a half ago or something. You made the valuation argument relative to NVIDIA. And again, we think about market share, you think about participation in some of these data centers and the like, or the servers into the data centers. There's some names that are probably underappreciated, but you made the point about valuation there. That seemed to be worked out pretty well. This might be a very similar situation.
Talk to us about Brunson, Dan.
All right, here's the deal. About 9 weeks ago, Guy, about
I
9
believe
weeks
so.
ago,
I believe so.
we put this in the podcast store, in your favorite podcast store. This is an AI-generated podcast that the Risk Reversal Media team puts together every day. It drops in your podcast store shortly after the opening. What we're doing, we're taking 10 of what we think are the most important stories in the markets, in the economy. We're banging it into one of those kind of wrappers, like a large language model. We're using Perplexity. It gives us a text. We put it into Brunson, which is a voice bot, and you get this great podcast in under 10 minutes of some of the biggest stories of the day. So that's it. Go follow it, rate it, review it, share it with your friends. Enjoy Brunson.
Interesting day. A lot of day left. 140. So you got to, cut 2.5 or so hours left in the trading day. A lot of strange things can still happen. If there's one thing that sticks out to me today, the fact that the VIX is unchanged again, I would have thought with all sort of the gyrations we're seeing, we would have seen a follow through in the VIX. Maybe we'll get it late. But that's it, Dan. Carter, you are the man. I think, Dan, we're back tomorrow. And if I'm not mistaken, EYT will be joining us.
Yeah, hopefully. I think she is, or she might be on her way on a trip. But either way,
you know what? You'll have us. So if she's not around, you're stuck with us. So there you go.
Fair enough. Thanks, Carter,
folks.
for doing some heavy lifting today.
All right, great. Talk soon. Bye.